Over the past few weeks, lots of news about the US debt ceiling been all over the feed, with Yellen saying that not raising it would trigger a global economic downturn and risk. Also, Yellen has forecast that the United States could run out of cash and extraordinary measures to pay its bills as soon as early June. More than 140 top business executives urged President Joe Biden and top congressional leaders to act swiftly to avert a potentially disastrous U.S. debt default. And a report by the White House Council of Economic Advisers predicts that a long-term U.S. debt default would lead to 8.3 million job losses, a 6.1% contraction in GDP, and a 45% plunge in the stock market. Even if it drags on until the last minute when Congress reaches a deal and there's no default, it will result in 200,000 people losing their jobs and a 0.3% shrinkage in GDP. Also, you may remember the debt ceiling crisis in 2011, which led to a downgrade of the U.S. sovereign credit rating by S&P and a 17% plunge in the U.S. stock market. So, what will be the impact of the U.S. debt ceiling crisis for the crypto market? Geoff Kendrick, Standard Chartered head of digital assets research, says Bitcoin prices could rise 70% if the U.S. defaults on its debt. Could this really happen? Hello everyone, this is Bearish. Today's video is about the potential impact of the debt ceiling issue on the price of Bitcoin. If you like this video, press like and subscribe. As always, this video does not constitute any investment advice. Just do your own research. So, first, we need to understand what the debt ceiling means and what has happened historically when the debt hit the ceiling. Prior to 1917, there was no debt ceiling, and in order to prevent the government from overborrowing, the government needed congressional authority to issue debt. However, after the outbreak of World War I, the demand for debt issuance in the United States increased dramatically. In order to increase the government's flexibility in issuing debt, the Second Liberty Bond Act of 1917 was passed, setting a debt ceiling of $15 billion, which allowed the federal government to issue debt freely as long as it did not exceed this limit. If the debt ceiling is hit and Congress has not agreed to suspend or raise the debt ceiling, the national debt will not default immediately because the Treasury can still use extraordinary measures and the Treasury General account. It will last a while longer, but when these extraordinary measures and the TGA account are exhausted, it will be time for the default date, the X-date. On 19th January this year, for example, the US federal government debt reached the $31.4 trillion ceiling, and the US Treasury Secretary Yellen said that X-date could be as early as June the 1st. While some institutions estimate that the X-date may be later than the 1st June, it will not be much later, and the risk remains high on early June. As approaching this deadline, uncertainty in the financial markets will grow. Although the two parties have not agreed on debt ceiling so far, it is widely believed that an agreement will eventually be reached before X-date, and the possibility of default is very low. The game around the debt ceiling is essentially a game of cowardice, with both parties aiming to use the debt ceiling to achieve their goals. But neither can afford the huge cost of a debt default and are only trying to delay and force the other party to give in. So, while the consequences of a default are severe, the likelihood of such a default is very low. Once this happens, it will have a huge impact on all global financial markets. US treasuries have long been regarded as safe assets globally. Therefore, many countries, institutions, and individuals hold large amounts of US debt. Once the US debt defaults, it may lead to an unprecedented crisis of confidence, a massive sell-off of US debt, an outbreak of liquidity crisis, and commercial banks holding large amounts of US debt may also face another round of extinction. In this scenario, the Federal Reserve will likely have to release liquidity into the market in response to the crisis, favoring Bitcoin. More likely than a default, in a delay until a last-minute deal is reached to suspend or raise the debt ceiling, as happened back in 2011 and 2013. So, until the debt ceiling issue is resolved, financial markets will remain highly uncertain. As evidenced by risky assets such as equity falling, the US dollar and short-term treasury falling, and safe haven assets such as gold, strong currencies, and long-term treasuries rising. We have already seen a recent rise in the price of gold and a sell-off in short-term treasuries. As for the impact of the US debt default issue on Bitcoin prices, it has to do with whether investors view Bitcoin as a risky or safe haven asset. The Bloomberg survey shows that to hedge against the risk of default on US debt, more than half of professional investors choose gold, followed by US bonds, which comes in a somewhat ironic second place considering that this is to hedge against the risk of default on US debt. This suggests a lack of alternative safe haven assets and that the market's trust US government remains relatively high, with long-term treasuries less exposed to the risk of default and investors confident that even a default will eventually be paid off just later. In third place is Bitcoin, supporting the Japanese yen and Swiss franc. However, it is also evident from investors' choices that Bitcoin is more volatile and has a smaller market cap compared to gold, and Bitcoin is not yet comparable to gold as a safe haven asset. Particularly in recent years, Bitcoin movements have been positively correlated with the Nasdaq most of the time, often diverging from gold's movements. So, on the level of safe haven assets, while there may be some people who will choose Bitcoin as a safe haven, there may also be a significant number of people who will choose to pull out of Bitcoin. The impact of the US debt crisis on Bitcoin, on the one hand, comes from changes in the US dollar. The risk of default on US debt can damage the credit of US dollar, depressing the dollar exchange rate and benefiting Bitcoin. For example, during more serious 2011 and 2013 treasury debt ceiling crisis, the dollar index saw some decline. And after the debt ceiling issue was resolved, the dollar index rallied. Recently, the dollar index has fallen back and Bitcoin has had a relatively large gain. Bitcoin is also at risk of falling back in the short term if the US debt ceiling issue is resolved before X date. On the other hand, there is the impact of US debt ceiling issue on liquidity. Bitcoin price movements are closely linked to a global liquidity environment. Prior to X date, the Treasurer's depletion of the TGA account amounted to releasing liquidity into the market, which also benefited the Bitcoin price, while the Treasury's refilling of the TGA account after the debt ceiling issue was resolved could bring about a contraction in liquidity. So, unless there is a real default on US debt leading to a devaluation of the dollar, or even an outbreak of a liquidity crisis, a banking crisis and a recession in the economy leading to the Fed having to restart QE and in turn, Bitcoin being able to benefit from it. In the event that the debt ceiling issue is resolved, Bitcoin prices could see a correction in the short term, if not driven by other events, given that the US dollar index is likely to strengthen and the liquidity remains tight. Of course, in the long term, governments will undoubtedly continue to issue more debt and print more money, as has happened countless times throughout history, and the value of Bitcoin, which is decentralized and known for its anti-inflationary nature, will come to the fore. While we may not be able to control the outcome of debt ceiling issue, we can decide where to store the value and fight inflation. What do you think about the impact of the debt ceiling issue and how it will affect Bitcoin? Feel free to discuss in the comments and remember to like and subscribe. See you next time.